we've been pretty constructive on the market since the start of the year, and we haven't really changed it. If anything, we've become incrementally more bullish, right? We've been underweighting gold a couple of weeks ago. We've been really moving high yield credit to maximum overweight over the course of the first quarter, gone a bit more overweight in equities. I would still say that, all the things are in place for some further gains, because all of our sort of macro leading indicators are actually still ticking up. Bottom up, our earnings indicators are looking a little bit better as well. You guys have just been talking about the earnings season, and particularly when we look at around earnings estimates of cyclicals, right? The cyclical sector, cyclical companies, they've been massively downgraded for the near term. It's a different story for the second half, but that's something to worry about in 6 months' time, right? Once we see perhaps the Q3 reporting season. But so far, Q1, Q2, right? So those estimates have really been slashed massively. So we have a mix of our leading indicators, bottom up going up, top down going up, sentiment not particularly exuberant, I would argue still a bit more on the defensive side, and near-term growth expectations pretty subdued. That's a pretty good combination for further gains and risk assets more broadly.
Get this straight, Max, and I think the word there, the key word that I focus on was tactically. So look, there are opportunities to the upside, but you don't necessarily want to put the house on it for the rest of the year. You think actually tactically for a bit further and then you get out, yeah?
Yeah, I don't want to put the house on it, most likely because I personally just bought a house, so probably not put the house on it. But I think we'll probably have some more gains to come until the summer, really. So sort of probably in the next sort of 3, 4, perhaps 5 months. The problem will come towards the summer or early autumn, because what we will then have is basically a combination of much higher growth expectations, both top down, so on GDP and so on, but also on earnings, right? We will be faced with much higher earnings expectations. On our estimates, headline inflation in the US will then also re-accelerate by the end of the year, right? Sort of end of Q3 and in the fourth quarter. And on top of that, we obviously have these 2 rate cuts, almost 2.5 rate cuts priced into futures. And that is a big, big problem, because those 3 are mutually exclusive. One of those 3 has to be wrong, right? We can say that perhaps the growth is going to come through, but then inflation might be re-accelerating even more, and then those rate cuts really have to be put off the table. So that is sort of our view, really, that we will be seeing perhaps those rate cuts coming off really towards the autumn. And then we might be facing really another period where perhaps all of the asset classes face a little bit of danger, at least tactically, before we can go then more constructive.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.